Hello everyone, welcome to another video of Decoding IPOs by Finance and Investment Cell of Kirori College. My name is Chris Taneja and today I'll be presenting and analyzing the IPO of Schloss Banglore Limited. Let us look at the company introduction. Schloss Banglore Limited, the operator of the Leela Hotels, was incorporated on March 20, 2019 as a private limited company in New Delhi. It was renamed as Schloss Bangalore Limited on July 3, 2024 when it transitioned into a public limited entity. As of March 31, 2025, Schloss Bangalore Limited is operating under the Leela brand, which stands as one of the India's prominent luxury hospitality companies. It manages a portfolio of 13 operation hotels comprising 3,553 keys. The core business includes luxury hospitality under the Leela brand, operating 25 plus premium hotels, resorts, and places. Its key segments are leisure, weddings, MICE. The vision is to dominate India's luxury tourism market through curated experiences. Now, let us first look at some IPO dates and prices. So, the IPO opening date would be May 26, 2025, and it would be closing at May 28, 2025. The face value is rupees 10 per share. The price band is 413 to 435 per share. Lot size will be 334 shares, and the total issue size is 3,500 crores, which comprises of a fresh issue of 2,500 crores plus an offer for sale, which is of 1,000 crores. The issue type would hence be an equivalent IPO. The tentative allotment date would be May 29, 2025, and the credit of shares to DMAT would be on May 30, 2025. So the tentative listing date is hence June 2, 2025. Coming on to the industry analysis, the market size and growth was reflected by the luxury hotel market size, projected to reach 24,900 crores by 2025, growing at a CAGR of 10.06% to 40,200 crores by 2030. Overall, hotel industry is valued at 1.3 lakh crores in 2024. The key drivers include MICE tourism boost, 10 lakh crore wedding tourism industry, government push for tourism infrastructure. Indian Hotels Company seems to be the market leader with 50% market share. Schloss Company manages 3,553 keys, and its RevPAR is among the highest in the industry of 9,592. Its estimated market share is to be 5% in the luxury segment. Now, the revenue has been increased by 20.1% in FY 2025, and the EBITDA has also increased. Plus, the net profit has been made a turnaround as the company was making losses in the past 2 years in FY 2023 and FY 2024. So, a profit of 47.65 crores is the turnaround for the company. Coming on to the financial analysis, we can see that by some ratios like ROE and ROC, which suggests that the company is lacking behind as in weak capital utilization, as its ROE and ROC are less than the industry average and its competitors. The debt to equity ratio has fallen due to the reduced amount of debts, as most of the proceeds were to be used in repayment of debt, which is not a good sign for an IPO. The interest coverage has also reduced as there are lesser interest payments now due to the repayment of debt. The current ratio has increased, indicating improved liquidity. The asset liabilities position tells us that the owned properties are 4,340 crores. The lease managed assets are 1,860 crores. So most of it is the owned properties, as it's common for a company in the hotel segment. The cash flow analysis tells us that the operating cash flow is mostly EBITDA driven. The investing cash flow is a capex for the 7 new hotels, and objective of the IPO is also to expand by 7 more hotels. The financial cash flow comprises of the issue which was raised by 3,500 crores. The key risks include the overvaluation, as P ratio of 213 is extensively high from its competitors and higher than the industry median. There is an execution risk, as there could be delays in adding 678 rooms, which means 7 new hotels by 2028. It could lead to operational delays and execution delays, which is a risk as considering the future market conditions and uncertain economic conditions. The cyclicality suggests that luxury demand is tied to economic growth, which could also pose a risk in the future if the economy becomes volatile. The debt relapse suggests that risk of renewed leverage expansion cost overrun. Comparing it with the peers like Indian hotels and Oberoi hotels, the RevPAR of Schloss Bangalore is higher than Indian hotels and is highest among the industry compared to its competitors, although it's lesser than Oberoi hotels. The P ratio suggests that Schloss Bangalore is relatively costlier than its competitors who apply for and to invest in, since it is not the market leader also. So it is a negative point. Debt to equities post IPO is lesser of Schloss Bangalore due to the repayment of debt. So we can analyze the Schloss trades at a 6x premium to Taj on P, but justified just partially via RevPAR leadership. So overall, which may suggest that there are future growth prospects for the overvaluation of P, but since it is extensively overvalued, it should be given less weightage to the future growth conditions. IQ objectives are debt reduction, expansion, and working capital needs. The subscription status and GMP trends suggest that there has been low subscription and the IPO will be likely not be fully subscribed. There is overall 6% subscription on day one and 17% subscription on day two. The analysis suggests that the retail enthusiasm contrasts with institutional apathy, and the negative GAP, which is possible, signals that listing would be slightly below 435. So the valuation suggests that the post-IPO EBITDA is 22.5x and enterprise value of 15,763 crores with a lower debt reduction. Uh, Even post-debt repayment, the valuation remains disconnected from earnings reality. Any slowdown in revenue growth could punish investors more. Now let us look at our final verdict. We would suggest that we can skip this IPO and we shouldn't apply in this IPO due to the four main reasons. There is a large portion of IPO proceeds for debt repayment, as 71% of the funds are used to repay the debt. And post-IPO debt reduction improves the balance sheet but offers no growth visibility for investors. The extremely high P ratio of 213x suggests that IPO is 6x costlier than peers like Taj. Even with optimistic FY26 projections, the valuations remain stratospheric. There is a very weak GMP and there would be a likely a listing loss of 5 to 8%. And the low institutional interest suggests that the retail level subscriptions of only 41% on day two are unsustainable for post listing listing stability. Thank you so much.